based on my wealth, is there some type of formula I should apply to my charitable donation process?
That's a very personalized conversation, depending on how much you want to give back, based on a percentage of your income or a percentage of your overall earnings, including your investment portfolio. We have families that tithe and give a percentage of their income. We have some families that don't give at all. So from our view, what we want to do is just understand what your charitable goals are. And then we want to look at the most optimal way to do that, whether it's a donor advised fund, giving directly to an organization, but then also how to fund that, whether you put cash in there or even highly appreciated stock.
Tell us what a donor advised fund is, what the advantages are, and how one would go about setting one up.
Absolutely. Donor advised fund are great resources to really help streamline your charitable giving. So what a donor advised fund is a donor account that is specific to you and your family. So you can create any name that you want on behalf of the account itself. But a lot of times we say it's like your own little private foundation in a much more cost-effective way. You set up a donor advised fund through another institution such as Schwab Charitable or even Fidelity Charitable, which are two of the largest donor advised funds out there today. And what this allows you to do is to make contributions to this account and immediately get a tax write-off in that calendar year, but with no requirements to distribute those funds in that calendar year. So you can really build this account up to create a family legacy to distribute the funds over the coming years.
So what are the considerations when someone's thinking about setting up a donor advised fund? What things should they be thinking about?
Absolutely. So number one, if you are charitably inclined, this is a great resource, as I mentioned, to streamline your charitable giving, because your tax write-off is going to go to the charitable organization that you donate to, such as Schwab Charitable or Fidelity Charitable. When you put money into the account, that's when you get the tax write-off, but when you distribute the funds, you do not get another tax write-off. So thinking around the timing of your distributions and how you go about doing that is something you definitely want to consider when you're making a contribution to a donor advised fund.
What types of resources are available to me as a charitably inclined person to expand my horizons, to learn what else I could give to? And part two of that question is, when I actually give the money, does it come in my name or does it come in the Schwab name?
Yeah, so the answer to your first question, there's a lot of great resources, and that's where we want to understand what your charitable goals are and how much you're looking to give. Because when you think about just the donor advised fund itself, because money can stay in there, you can use that for even teaching your children or other family members of how to give as well. For a lot of our clients, what we'll do is have conversations and think about an allocation they can utilize for their children, meaning that they can explain to them that there's X amount of dollars to give out. Their children go out and they do the research on their favorite charitable organization and come back and present that to the parents. And then they all make a choice of where that money is going to go and how that's going to be given, out of the donor advised fund. As you go into the higher values and you're thinking about more legacy planning, there are other consultants that we do work with that have the resources to think a little bit more in depth about what type of charity you want to give to or how you want to give that. So those are resources that we have access to that we identify that obviously we bring those partnerships in if needed as well. When that money goes out of the account and you do make that gift to the charity of your choice, you can actually designate the purpose behind that when you're filling that out online, but then also the name you want on there. When I think about best practices, it's about putting money into there too. How do you think about best practices around funding? And that is going to be even specific to your situation relative to the balance sheet that you have. We have a lot of conversations when we're thinking about charitable giving. We discover that you may be just writing checks, and writing a check is great to an organization, but there might be a more optimal way to do that. And one of those ideas is just gifting highly appreciated stock from a brokerage account or another personal investment account that you might have. A couple of the benefits relative to gifting highly appreciated stock is, one, you have to have it held more than 12 months, so it's long-term capital gain stock. Two, when you make that charitable gift into the donor advised fund, that it allows you to take the full write-off for the value that you put into it, but then it also allows you to avoid the capital gains tax on that. So for example, if you had a cost basis of $1,000, which on Amazon stock is what you bought it for, and now it's worth $10,000, you can gift that $10,000 in there and avoid that $9,000 capital gains tax. And then if you want to maintain that position, you have the luxury of buying that stock right back and own that same position. And the beauty of that is now you have a step up in basis. So now your cost basis on that position is $10,000 versus $1,000. So it allows you to be a little bit more strategic relative to the dollars you're giving, and obviously avoid some potential tax out there as well.
So if I'm thinking about in a certain tax year, I'm going to have a lot of extra income, it might make sense for me to contribute more to the donor advised fund. Let's say put $100,000 in there, and therefore I can write that off of my current year taxes and then distribute that money over future years. Are there any requirements to distribute that over time?
There's not. These accounts allow you to be a little bit more strategic and tactical relative to your charitable giving. Specific to recent changes in even the tax laws of the standard of doubling of the standard deduction, that's really eliminated a lot of folks to even get tax deductions for their charitable giving. And right now in this calendar year, 2020, the standard deduction is $24,800. So first and foremost, a lot of families are not even itemizing where if they make a donation for $5,000, they're not even getting a tax write-off for it. So you have the ability to be strategic and maybe even stack your donations in one calendar year to not only get over that hurdle mark of the standard deduction, or if you're going to be in a higher tax bracket, contribute 2 or 3 years worth of donations into this donor advised fund and then distribute it over the years to come.
And so in thinking about the sort of the stacking, or let's just say in this case, I give the $100,000 donation in this tax year, what happens to my control over that money? Do I lose control over that money? What happens to the securities? Can I invest them differently? Tell me what happens once the money's sort of in the donor advised fund.
Yeah. So once you make that contribution, that is an irrevocable gift, as you're making a donation to Fidelity or Schwab Charitable in this example. And that money, once it goes into the account, if you donate a highly appreciated security such as Amazon or Apple, you put that in the account and that position is immediately sold. So that money that is in the account now is reinvested into a diversified low-cost portfolio that you can customize and select based on the provider that you're using. And that money can stay invested and grow based on the market going up or down. And if it has the ability to grow over the time that it's in there, you get to donate that money out in addition to your principal balance that you put in there as well.
Okay. And there's no tax consequences if that money grows by 30, 40, 50%. The benefit is to the charity you're giving that money to, correct?
Absolutely.
And in terms of the investment process, how should someone think about that money from an investment standpoint once it's sort of left their use and is now a charitable use?
Exactly. Yeah, similar to how you think about your own personal investment process, it's really about how much risk you're willing to take, but then also the time horizon around those dollars. Because a lot of families will put money in and then that money will go out within a month or two. But if you have the luxury to have that money stay in there, or if you overfund that in one calendar year, you want to think about your distribution schedule, because that will drive the asset allocation that you choose. Obviously, if the money's going out sooner, you may want to be a little bit more conservative with it, as that's more near-term money you want to make sure is set aside for your charitable donations going forward.
Another opportunity, Neil, is gifting straight from or making a charitable deduction straight from your IRA. Can you walk us through what the rules are around that?
So qualified charitable distributions is a great strategy, as we talked about, even thinking about optimizing your charitable gifts. Now, this is specific to individuals and families that are subject to either required minimum distributions or at least over the age of 70 and a half. And the benefit here is if you are going to gift directly out of your retirement account to a charitable organization, This one allows you to do that and avoid any income tax on that distribution. But if you do this, you do not get an additional tax write-off. Essentially, your tax benefit is not paying taxes on that distribution. And then if you are subject to required minimum distributions, this actually helps satisfy your required minimum distribution. And you can do this up to $100,000 per year out of your retirement account. One of the questions we do get quite a bit is, can I take money out of my IRA account or my retirement account and put that into a donor advised fund? The answer is no. So if you're going to make a qualified charitable distribution, that has to go directly to a qualified charity. And the nice thing is that a lot of the institutions now allow you to have a checkbook off of your IRA account. So you can actually write those checks directly to the organization or make an electronic transfer out of your retirement account.
Using a charitable donation to offset the tax costs of converting a traditional IRA to a Roth IRA, a strategy that people should think about?
Yeah. When you are making charitable gifts, that is helping offset ordinary income. So if you are looking to be strategic from either Roth conversions and you are charitably inclined, that is actually a great strategy to help offset that ordinary income that might spike your tax bracket by moving money from a pre-tax IRA to a Roth IRA. So the example just to use, if you converted $100,000, that's going to push your income up $100,000, but a way to potentially limit that tax impact is by coupling that with a charitable gift as well. So there's a lot of different ways to give, from your own personal time to giving, clothes or any other items from your household that a lot of people give. Sometimes you might give cash or even other investment securities. Obviously, there's a lot of different ways to give, and what we're here to talk about today is really just one specific, way to give. At the end of the day, it's really a personalized decision, and we want to make sure you're at least optimizing your opportunities and potential efficiencies around your charitable goals.